Hi, my name is Bashir. Today, I'm going to brief you about how to checkmate the portfolio perspective of investment and how investors makes decision when losing money or making money. Last week, we talked about the risks and return concerning investment. So the portfolio perspective of investment actually captured various assets or securities or instruments or shares, let me say, in to be one, let me put it that way, to be one. So if you have, for example, here you got stock A and you got stock B. So the combination of stock A and stock B will give you stock A and B. Okay, so the stock A and B is to be evaluated as a portfolio because this is one asset, this stock B is another asset. So the combination makes them to be a portfolio. It's a pool of securities, a pool of financial instruments, it's a pool of shares, bonds, whatever, in to be one, let me say. So the portfolio perspective now it considers the individual evaluation of stock A and stock B with let me say the contribution of those investments, the two investments uh, of the whole portfolio. So the performance you're trying to check the performance of A and also try to check the performance of B. So as an investor who wants to invest, you don't need to limit yourself into just like put your head into one basket because that could be very risky, because the ups and downs and the market dynamics could affect your stock if you're just investing in, for example, Tesla, or just investing in Starbucks, or just investing into Microsoft. So if you have in stock A, for example, let's say you have Tesla in stock A, you have Microsoft, right? You have Apple. Okay, that's a stock A, and your stock B, you have Alphabet, right? You have Amazon, you have Tata in your stock B. So the combination of the stocks is going to be Tesla, Microsoft, Apple, Alphabet, Amazon, and Tata. So the portfolio perspective, it's checkmating the individual characteristics, the individual performance of the security in just one pool. So the ups and down in pool A, the ups and down in pool A can be matched with the ups and down in pool B, meaning if you have if the dynamics, or let me say the volatility or the risks, it's moving up and down between minus 10% to minus 25%, and the risk is moving between 10% to 25%. Okay, do you get that? And the pool B, you have the ups and down moving between minus 15% and minus 30%, and the return is moving between plus 15% plus 30%. So basically, what this means is that the ups and down in Tesla, Microsoft, and Apple is going to complement the ups and down in Alphabet, Amazon, Tata. So you're not putting your head in one basket. You have the combination of different type of stocks in one. So this make them to be a portfolio because the combination was going to give you like it's going to help you to checkmate your risk and return. And if you look at let me put on this graph, for example, you have your return here and you have your risk here. Just so you know that the lower you invest, the lower the return, and the higher you invest, the higher you return, the higher you get your return. So it moves this way. It moves just from this point here to the point here. So if you have, for example, you have 5, 10 percentages, 15, 20. That's the return. And the risk here is 5, 10, 15, 20. So for every 5% risk you take, or for every 5% return you take, you're going to make 5% risk. For every 10% return you make, there's propensity you're going to lose 10% risk. For every 15% return you make, there's propensity you're going to lose 15% risk. For every 20% return you make, there's propensity that you're going to lose 20% risk. So the higher the return, the higher the risk. The lower the return, the lower the risk. Just like the way the principle of demand and supply works. So investors need to know that where there is no risk, that means the expected return is very free. Okay, that means the expected return is risk free. And there are situations, there are financial instruments, or financial instruments, or financial derivatives, whereby the risk is very low. So it's kind of like risk free. For the propensity of you losing your money is very low. So, for example, we have a bond. I'm gonna go deep in this later on, but let me just branch through it for a while. So the bond is a government financial paper or financial instrument whereby the government issue out this document out to people, to financial institutions, to government, to individuals, to commercial banks, and all, for them to buy, so that they could have a return of depend on what the value return is. It could be 5%, it could be 10%, it could be 20%, but the return is basically fixed. The return is basically fixed. So in this scenario, the chances of you losing your money, the percentage of the risk is nil, because this is a financial paper where the government controls the inflow and the outflow. So unlike commercial banks that issue out maybe commercial papers or maybe some form of financial instrument whereby the risk and return is not determined, you understand? So when the risk increases, okay, in normal situation, when the risk increases, the return as well increases, the propensity of you getting your money increases. But for you to have a well outcome of whatever you invest in, you need to invest your securities or your shares or your bonds or your debentures or your commercial papers for a long time period. For a long time period. And long term period is above 5 years. It's above 5 years. So a short time period, basically, a short time period is below 5 years. Okay, so this is basically what the portfolio perspective of investment explains. Thank you so much. See you in my next class. I go by the name Bashir Salako.